There's a quiet storm brewing in Canada, one that isn't making front-page headlines yet, but it's already knocking on millions of doors. If your mortgage renews anytime between 2025 and 2027, this storm has your name on it. Imagine opening a letter from your bank that says, "Your new payment is $975 higher starting next month." You didn't move. You didn't refinance. You just renewed. Welcome to Mortgage Renewal Shock 2.0, the second more brutal wave of Canada's housing crisis. It's not theory, it's math. Tens of billions in mortgages will reset at double or triple their old rates. And the worst part? The first wave already hit in 2023 and 2024. This next one will decide who keeps their homes and who loses them. Let's be real, most of us didn't buy mansions. We bought what we could afford at the time. Maybe it was that small semi in Mississauga, or the condo in Burnaby, or a townhouse in Calgary. You stretched, but you made it work. Then life happened. Groceries doubled, daycare costs climbed, and interest rates exploded. You tell yourself, okay, I'll manage until renewal. But what happens when renewal comes, and the bank says, your 1.8% fixed is now 5.6%. For a $700,000 mortgage, that's an extra $1,000 every month. That's groceries. That's gas. That's peace of mind. The truth is that this isn't your fault. The system was built on low-rate addiction, and now Canadians are paying for it. The hidden wave, what's coming? You might think, sure, rates are high now, but they'll drop soon, right? Maybe. But even a drop from 5.5% to 4% doesn't undo the damage. The Office of the Superintendent of Financial Institutions, OSFI, revealed that by 2027, roughly 31% of all Canadian mortgages will renew. That's over 3 million households, most locked in between 2020 to 2021 when rates were the lowest in Canadian history. This is what economists call the renewal wall. These people are all hitting the same wall at the same time. Fixed rate holders at 1.7% will face renewals at 5 to 6%. Variable rate borrowers are already bleeding. Some saw payments rise 40%. And nearly $675 billion in mortgages will reset over just 24 months. That's a wave powerful enough to shake the entire economy. Why this is happening, the economic chain. Let's decode this simply. In 2020, the Bank of Canada slashed interest rates to 0.25% to keep the economy alive during lockdowns. Real estate boomed. Home prices soared. Borrowing felt cheap. But in 2022, inflation hit 8%. The Bank of Canada slammed the brakes, 10 rate hikes in 16 months. That's the fastest monetary tightening in modern Canadian history. And when rates jump that fast, they don't just affect new borrowers, they ricochet into existing ones. Now, even if BOC cuts 1% or 2% in 2025, it won't return to the golden days of 1.5%. The new normal is somewhere around 4% to 5%, permanently higher. Add to that stricter OSFI rules. Lenders must stress test borrowers at 2% above the actual rate, meaning approvals are tighter and renewals riskier. This isn't a temporary shock, it's a structural shift. Who will be hit hardest? So who's most at risk? Let's be brutally honest. 1. First-time buyers, 2020-2021. They bought at peak prices with record low rates. Many have little equity, and the math no longer works. 2. Variable rate borrowers. Half of all variable rate mortgages now have negative amortizations, meaning payments aren't even covering interest. The balance grows monthly. 3. Investors and AMP. Landlords. Rental income that used to cover mortgage plus tax is now running deficits. Many landlords are selling, triggering capital gains hits. 4. The self-employed and AMP. Small business owners. They face renewal challenges because banks now reevaluate income stability and debt ratios, tougher under higher rates. 5. Retirees with reverse mortgages or HELOCs. Their cash flow shrinks and variable rate HELOC interest compounds rapidly. The renewal shock doesn't discriminate, but it punishes those who don't prepare. The domino effect, how it spreads. This wave doesn't stop at your front door. It ripples through the entire economy. Let's trace the dominoes. Domino 1, housing affordability tanks. Renewals kill demand, sales drop, listings rise. Domino 2, rent spikes. Landlords with higher mortgages pass costs on to tenants. Domino 3, equity erosion. Falling prices trap homeowners with little or no equity. Domino 4, consumer spending collapses. Mortgage-heavy households cut dining, travel, and retail, shrinking GDP. Domino 5, job losses follow. Construction, retail, hospitality, all slow down. Domino 6, the psychological toll. Financial anxiety, relationship stress, mental health hits. In a country where 70% of household debt is mortgage-based, this isn't just a financial event, it's a national stress test. And like all stress tests, some will break, but others will adapt and emerge stronger. The survival blueprint, 6 steps. Let's flip the script. You don't have to be a victim of this renewal shock. You can prepare, adapt, and even thrive. Here's your 6-step survival blueprint, designed for 2025-2027. Step 1. Start negotiating early, 12 to 18 months before renewal. Most Canadians wait for the bank's renewal letter. Huge mistake. Call your lender or broker early. Ask about blend and amp, extend offers, where you merge your current rate with the new one. You might lock in lower than market if you move early. Step 2. Recast your amortization, but strategically. Extending from 20 to 30 years can lower payments by 20 to 25%. But don't do it blindly. Use that breathing room to build an emergency buffer, not to increase spending. Step 3. Optimize all other debts. Consolidate high-interest lines of credit or credit cards into a lower-rate loan before renewal. Every $10,000 in consumer debt is equivalent to about $60 a month in lost housing affordability. Step 4. Use rate layering. Mix short and medium-term fixed products to hedge against rate swings. Example, 1/3 in a 1-year fix, 2/3 in a 3-year. You balance flexibility with protection. Step 5. Downsize or refinance early if needed. Don't wait until panic forces you to sell. If you already know the numbers won't work, list early, while buyers are still in the market. Selling strategically is power. Selling desperately is loss. Step 6. Build a mortgage reserve fund. Treat your mortgage like an unpredictable expense. Automate $200, $300 a month into a high-interest account. By 2026, you'll have a $6,000+ buffer, enough to cover rate jumps for months. Case studies, 3 stories. Let's make this real with 3 stories from real Canadians. Case 1. The prepared couple, Brampton, Arjun and Priya, renewed early, 9 months before maturity. Their broker locked them at 4.5% while rates were rising. They also added a basement tenant. Result? Renewal hit, but payments stayed manageable. Case 2. The investor, Calgary AB Ahmed, owned 2 rentals. He knew he couldn't survive both renewals, so he sold one early, took the equity, and used it to pay down the other. Instead of losing both, he kept one property, cash flow positive. Case 3. The late reactor, Vancouver, BC. Emily waited until her 2026 renewal letter arrived. Her payments jumped $1,050. She panicked, refinanced into a 30-year term at a higher rate, and drained savings to survive. Same market, same conditions, 3 different outcomes. The difference? Preparation. I know this video might feel heavy, because what's happening isn't fair, it's systemic. But you can't control the policy. You can control your preparation. The people who start acting now, tracking rates, talking to brokers, reducing debt, saving buffers, will not only survive 2026, they'll have leverage when others panic. Remember, wealth doesn't vanish in crises, it transfers. Those who plan early catch it on the way down and own it on the way up. So start now. Find your renewal date. Call your lender. Run your numbers at 6% and build your safety buffer. Comment below. My renewal year is vague. I'll respond with a tailored strategy for you. Smash that like, subscribe to Financial Mo, and share this with a homeowner you care about. Because this isn't fear content, it's survival content. Stay calm. Stay strategic. And as always, keep your money working harder than your mortgage.